Gold is telling us, uh-oh, we can't do that anymore. And if we can't do that anymore, then what does that mean? It means that our standard of living is going down. And this is the thing that people don't capture, they don't grasp. Okay. Put it this way, in a decade from now, the minority will not use money. A decade from now, the minority of people will not even touch money. It won't be part of their lives. Money won't be part of their lives. 2 years later, gold prices were still cheap because it takes a long time to plan these things. But by February 24, it started to become obvious. It kind of frustrates me because I've been doing it for 20, 30 years. And so I kind of know what's going on, and everybody else is a lot of people are new to it. And, they're kind of guessing, if you will. And so I get questions over and over again. The one thing is, people look for opportunity and they don't want to miss out on it. So a lot of people are coming into this gold and silver space because they see it as opportunity. And they don't really look at it from a big picture standpoint. People they want to make money like this quarter, this year. It's about making money, right? It's very focused in that regard. But what's happening in gold is a much bigger, important picture. And it frustrates me because it's really difficult to connect the dots unless you have some historical background. For instance, like Wall Street, they have two blinders that makes it really hard for them to understand that gold is kind of the boogeyman here, and it's a problem. And their two blinders is, number one is who they work for. So if you don't get in alignment with the company culture, you're in trouble, basically. You better line up, right? And the company culture is our customers, our investors, and we're constant salespeople for our customer, right? So that's the first blinder. The second blinder for them is they're very short-term focused. It's really hard for them to think more than 2 quarters out and 12 months out, 18 months out. So they have these double blinders, and it's so you're not going to hear the story from them. You're not going to hear the story from Wall Street. And the only people that really talk about it are the people that really look at it from a historical context. And people, they don't like to do that because, people always like to have a real short-term focus. They don't want to look at a historical context. But gold was $2,000 in February 24. That's not that long ago. What happened? What changed? We went from 2,000 to 5,000. It wasn't inflation that drove gold up $3,000. Something else. And nobody really wants to talk about it, or nobody really wants to think about it. But what changed was basically the US no longer has the economy that can support what it's trying to do. It's basically we've been living off of debt since the 1980s. So we were a mercantilistic economy until the early 70s, and then we couldn't do that anymore. And then in the 70s, we're trying to figure out what the hell, what's our new strategy? It was a really bad decade because we couldn't figure out what to do. And then we went into the 80s, and Reagan adopted globalism. And globalism is this idea that, you have free trade and everybody benefits from free trade. That's kind of the essence of globalism. Everyone's going to benefit. Whoever has the right skill set to make stuff, let them make it. And so we offshored our manufacturing base, and we created a services economy. Well, it turns out that was a really bad choice, and so now everybody seems to believe that we can just keep doing that. We can keep doing what we're doing, live off debt, use debt to maintain our standard of living, and everything's going to be kosher. Everything will be fine. Gold is telling us, uh-oh, We can't do that anymore. And if we can't do that anymore, then what does that mean? It means that our standard of living is going down. And this is the thing that people don't capture, they don't grasp.
Since the 1980s, the United States shifted from production to debt-driven consumption. Manufacturing moved overseas while borrowing filled the gap. For decades, this worked, until it didn't. Gold's surge reflects the realization that this model has reached its limit. A nation cannot endlessly borrow to maintain prosperity. As debt expands faster than real growth, the illusion collapses. Gold prices are reacting to this moment. The recognition that the U.S. can no longer preserve its global dominance through borrowing alone. A structural reset is underway.
The one clue here that we're not going to carry onward is the fragmentation that's happening globally. That's a clue. In other words, globalism is somewhat dead, right? And so that's not coming back to life. So that means there's going to be friction, a lot of friction, right? Because countries are going to put up trade barriers. Look at what China's going to do. They're basically going to hoard their silver, et cetera, et cetera. And so basically the difference between then and now is that globalism then was still alive and well, and now it's not. So you're going to get massive change, if you will. And this is what people are in denial of. People think that the US economy is going to maintain its dominance. It's not. Because once we can no longer borrow what we need to borrow, it's kind of game over for the status quo. And that's what I've been trying to let everybody know, is that once that status quo goes, kind of Katie bar the door, you're going to get a new economic system, a new monetary order, you're going to get a lot of friction. It's going to be messy. And so that's really the big difference. But I didn't answer this question accurately, because people aren't ready for the truth yet. But maybe next year, maybe the year after that. But I like to tell people, you have no idea what's coming. The change, what we're shifting into is not what people are expecting. Okay. Put it this way, in a decade from now, the minority will not use money. A decade from now, the minority of people will not even touch money. It won't be part of their lives. Money won't be part of their lives. That's how drastic the changes are going to be. You wouldn't think of it that way. Everybody needs money, right? So the whole idea of money is going to change. The whole idea of regulations are going to change. Corporations are going to change. Everything's going to change dramatically over the next decade. And it all starts here.
Central banks see what most investors ignore. As trust in U.S. Treasury debt erodes, gold reemerges as the ultimate risk-free asset. This shift accelerated after geopolitical shocks exposed vulnerabilities in the dollar-based system. When nations were cut off from global payment networks, the message was clear. Financial neutrality no longer exists. Gold has no counterparty risk, no political allegiance, and no expiration. That is why central banks have been accumulating it at record levels. This is not speculation, it is preparation for a new monetary reality.
And that was the beginning of BRICS Plus. 2 years later, gold prices were still cheap because it takes a long time to plan these things. But by February 24, it started to become obvious that the Chinese wanted to use gold as some type of a mechanism for international trade settlement. Now that's still underway right now, but it just looked like that was the path that China was kind of going down. So China was kind of monetizing gold. And then once that became kind of an accepted outcome, gold just exploded. It went from 2,000 to 5,000 because of this new monetary order. Now, silver has not been, basically only a base metal, and so it's been ignored. Now, once silver got above $35, it suddenly became a monetary metal. And now you have a problem because there's only 800 million ounces a year mined, and then another 200 million ounces a year recycled. So you got 1 billion ounces. Fabricators need about 700 million. So you only have 300 million left for investors. Well, that's not enough. If once it's a monetary metal, the investors go, well, we want some of that stuff too. So suddenly you got a problem. And so that's what's happened with silver. There's not enough for the investors. When I wrote my book, How to Invest in Gold and Silver, back in 2012, by the way, the 12th edition's out on Amazon. You guys want to read that. When I wrote that book, I said that silver is going to have a shortage. It's inevitable. And the reason why it was inevitable is because there's just not enough above ground silver to offset what investors want. And so that above ground inventory is just slowly getting whittled away. As a matter of fact, in March, there's a very good chance that COMEX will not have enough silver to deliver. Right now, it's looking really dicey in March. And even if they find enough silver to deliver in March, they're going to be pretty much out going into April, May. There was 49 million ounces delivered in January, which was a really high percentage. I think it was 90% of the contracts. I could be wrong about that. And then in February, it's very small. It's only like 18 million ounces already have been delivered in the first 9 days. And the deliveries have been 98% of the contracts have been delivered in February, which is totally unheard of. Usually it's like less than.
Silver follows gold, but with greater volatility and tighter supply. Once silver crosses certain price thresholds, it stops behaving like an industrial metal and re-enters monetary territory. That creates a problem. There simply isn't enough silver available. Annual mining and recycling barely meet industrial demand, leaving little for investors. As monetary interest rises, shortages become unavoidable. Delivery stress at major exchanges is already signaling strain. Silver's story is not independent. It depends on gold's direction. But when gold leads, silver amplifies the move dramatically.
Bottom line is silver has the wind at its back here because there's not enough inventory. And as long as gold trends higher, silver is going to outperform gold. So the GSR will keep squeezing. But the key here, again, it's gold. Gold has to lead. Gold has to keep going. Trend. It's going to be interesting to see, where gold ends the year. But I don't think 26 is the end of the bull market. I think we're going to go to 27 as well. And so it's pretty exciting times. But conversely, the most important chart for gold is the S&P 500. In other words, the S&P 500, gold loves the S&P 500. So the S&P 500 is at 69.50 today. That's really close to an all-time high. I mean, it's really close to 7,000. And so S&P up at an all-time high, gold loves that, absolutely loves it. So since 2024, anytime gold did a correction, as long as the S&P went up, gold said, oh, here I come. I'm following you guys. So gold loves the S&P. So if the S&P keeps trending, gold's going to keep trending. And so, but conversely, they're correlated. If the S&P decides to correct 5%, gold's going to correct too. And so that's I call that the last battle. The last battle is when the S&P 500 rolls over. It's a battle because it's almost impossible for gold and silver not to get dragged down with it. The only question is how much it gets dragged down, but it's going to be dragged. And so that's the last battle. And then they decouple, and then we win. So I don't feel like a winner yet, even though gold has went. Well, I kind of feel like one, but not. I don't know. I'm not holding the Super Bowl trophy yet. Gold has went from 2,000 to 5,000 a little over 2 years. Actually, 2 years. 1,500 a year. That's unbelievable. But we've done that by winning a bunch of battles. I won't go into the battles too much. Basically, the silver. Gold breaking out, silver breaking out, the HUI breaking out. Those were the three battles. The last battle is the S&P, when you get the decoupling. And so that's when we win. That's when then there's nothing to stop us. That's when the blue sky appears, is when the S&P stops going higher. And that's when the fear trade arrived.
Gold and equities have moved together, but that relationship won't last. As long as stock markets remain strong, gold can rise quietly. The real test comes when equities fall. Historically, gold initially drops with stocks, then decouples and surges. That moment marks the true fear trade. When confidence in financial assets breaks, capital rotates aggressively into hard assets. That decoupling has not happened yet. When it does, gold and silver enter their most powerful phase. Until then, the system is still pretending everything is fine.
Paramount Gold Nevada, they were valued around, $50 million for Grassy Mountain. And they were getting zero value for Sleeper. And everybody's like, oh, they have that Sleeper project over there in Nevada. Well, we're going to pretend they don't. And we're only going to value the company as if they only own Grassy Mountain. We see this quite a bit. We saw this with Next Gold when they had Goldboro and Goliath, and the market was like, we're going to pretend they don't own Goliath, right? And it was valued under $200 million. So we see these valuations that are basically mispriced, where they're only valuing them for one property when in fact they own two. Another example of that, these are opportunities. Another example of that is Discovery Silver. So Discovery Silver, they have 10 million ounces in Canada, which they're going to probably bump up to 500,000 ounces of production. And so the company's only valued for that. And they have Cordero over here in Mexico with 1 billion ounces, and they're getting zero value for that. Another one is Boumadine, Aya. So if you look at the valuation of Aya, it's basically only valued for Zagounder. Boumadine is over here on the side, massive project, no value. And so these are the things that I'm always looking for. I'm always looking for companies that are mispriced, very poorly priced, because they have these other projects that are eventually going to get built. The market refuses to value these things until they get closer to production. But you can, as a speculator, you can speculate that these projects are going to get built, and if they get built, you can make a lot of money. So I'll just leave it there.
Mining stocks lag until balance sheets improve. Once debt is eliminated, cash flow explodes, and valuations follow. Producers benefit first, then mid-tier companies, then developers. This is where compounding changes everything. As profits grow, multiples expand and gains accelerate exponentially. What begins as a double becomes a triple, then a tenfold return. These moves take time, but when they start, they move fast. The current undervaluation across mining equities suggests the market still doesn't believe what gold is already telling us.